we're coming to one of the highlights of this conference. And my job is a bit easier in this instance because each of the 4 panelists is famous. So I don't need to spend much time introducing them. It's to those actuaries who are new to CAD modeling is multidisciplinary. People from different disciplines are working together. A CAD model itself is the product of civil engineers, seismologists, atmospheric scientists, and hydrologists working together. So people who know about the buildings and what happens to them if you shake them, plus people who know about the perils working together and building a CAD model. And today's panel is also diverse in other aspects. Half of the panelists are vegetarians. Let me quickly introduce each of the 4 panelists. We're starting with Ashish Jain. Ashish is a Vice President and Managing Director of Extreme Event Solutions at Verisk's office in Singapore. He oversees all the office's operational aspects and leads the Verisk Extreme Event Solutions business development and consulting and client services groups across Southeast Asia, South Asia, Middle East, and Australia, New Zealand. His biography is much longer. You can read it in the conference brochure, but chances are you already know him. Similarly, Iain Reynolds. Iain has held several positions during his 7 years at Pigre. Prior to this, he had held positions in Guy Carpenter. Guy Carpenter had moved him around from Munich to London to Singapore. And prior to that, he was with GE Francona Re, with a reinsurer called Gerling Global Re, and with a model vendor called Equicat. Then we have Dr. Nigel Winspear. Nigel is the head of natural catastrophe analytics research at Sompo International, based in London. With over 20 years of catastrophe management experience, Nigel has worked with model vendors, insurers, brokers, and reinsurance across the London, European, and Asia-Pacific markets. And some of you may remember Nigel was based in Singapore until 2018. Then lastly, we have Brad Weir. He currently has both actuaries and CAD modelers reporting to him. Brad has been working in catastrophe management related analytics for over 20 years across Europe, Australia, and Asia. And the last 10 years, he was based in Singapore. I remember one fun fact about Brad. He once told me while he was still based in Perth, he would rather relocate to Singapore than relocate to Sydney. And now he is based in Singapore. Again, you can read in the conference brochure what Brad's current job description is. I rather use the time to share another fun fact. Around 10 years ago, Brad spent an interesting day with a fellow panelist, Nigel Winspear, exploring the Tatun volcanic group just to the north of Taipei City in Taiwan, searching for the quote-unquote unmodeled perils. And this panel will be moderated by Professor Shaun Wang, who had given us his insights earlier this afternoon. Ladies and gentlemen, put your hands together, virtually of course, for the 4 panelists and the panel moderator. The floor is yours. Thank you.
Thank you, Andreas, for your introduction. You could continue. Okay, in order to respect the time of our 4 distinguished panelists, distinguished experts, let's just dive in. I have prepared about 3 or 4 questions, so we have really 40 minutes left. So I just want to see a more lively kind of discussion. Sometimes maybe not so orderly, that's fine. Hope the audience will understand. Let's just dive in. I will kick off with the first question. The past year, with in terms of catastrophe events, whether it's earthquake or flood or wildfire, we have quite a number of big events. Maybe I can ask our panelists to just offer some quick comments, review of those recent events, so that the audience can relate better of later discussion. How about start with Ashish and then Iain and perhaps Nigel, just a suggestion. Yeah, let's get started. Yeah.
Okay, sure. Can you hear me all right?
Yeah.
Good. Yeah. Thank you, Shaun. Yeah, in the interest of time, we'll just dive in. There is always discussion when we event happen and results in a large economic or insured losses. And if you really look in the past 1 to 2 years, there have been few notable events. We had Hurricane Ian in the US, close to $50 billion of losses. Summer serious storm in France, windstorm in Europe. If you're looking at flooding, we have flooding in Australia, more deadlier flooding in Pakistan with more than $15 billion of economic losses with hardly any insurance losses because of the low penetration. But the main thing, if you just look at this year in February 2023, we had one of the deadliest earthquake in Turkey, which really caused around more than 30 billion of economic losses, around $5+ billion of insured losses, and the loss of life was really, really huge in tens of thousands of people. Yeah. If you look at in general, Turkey has seen quite a lot of devastating earthquake in the past. But when this event happened in February, a lot has been discussed about location of the event, size of the event, area impacted, and damages that we have seen due to this event, the kind of damages we have seen. But if we really go into detail, and if you look at the modeling world, given the science, given the seismicity we know, this kind of event was not an unexpected event. Very much scientific community expected that, that location will have that size, that magnitude of event. So there was no real surprises when that event happened. Yeah, there were surprises with respect to the amount of damages we have seen due to the performance of building, enforcement of building codes were there or not. But the event itself and kind of its footprint was not really a surprise. So yeah, in a nutshell, if we talk about Turkey earthquake, that event has been one of the most devastating event area. It has impacted hundreds of kilometers. But there was no surprise when it comes to its frequency or severity of the event in that location. That event was very much expected. But yeah, a lot more understanding as a modeling community and everybody, we need to do how the building code enforcement was there and mainly the damages it has caused. So yeah, I'll just pause here on Turkey earthquake.
Interesting, Ashish, you mentioned that you were not surprised that about the occurrence. For general public, I guess the sentiment is that wow, we have big surprises in terms of frequency and severity. I even early on used the delta. I'm wondering, earthquake may not be a climate event. What about the flooding or others? Maybe others can chime in, also comment on those trends.
Well, I'll jump in if I may, Shaun. I'll start with an anecdote. I was interviewed about a couple of weeks ago about CAT, and I chose to speak about flash flooding. And that was on a Wednesday, and on Thursday evening on my way home, I got very wet here in Hong Kong because we had flash flooding, which was knee deep where I live. And I guess I completely agree with Ashish's point about some things are not surprises, but I think over the last 3 years we have had quite a lot of surprises, mostly with climatological perils. And I think if we look at the region, the APAC region, we have seen a lot of flash flooding, and we've seen it in places that we wouldn't previously have expected to see it. Some places it was more predictable than others, but I think if you take this year, I don't think anybody was foreseeing such severe flash flooding in New Zealand. We've seen an industry loss probably 20 times what had previously been experienced. And, we're in a position where we're seeing in the region 2 flash floods a year. So in any one market, all of these look like a surprise. But I think if you're a global player or a regional player, these start to look like a trend. And yeah, I think that's the point on frequency and on flooding, is that this is starting to look like a trend for us.
If I could jump in now on wildfire, I would fully agree that certainly in the last 10 years, if not 7 years or so, globally speaking, the frequency and severity of wildfire losses does appear to have increased. Right, so the question then is, what is causing this? Right, and it's the same question with all of these climatological perils. What is causing this? Can we detrend and remove other factors to leave possible underlying causes? So wildfire, I'm thinking of Greece and Hawaii wildfires this year, and then looking back across North America, which tends to be driving the major losses, insured losses globally. 2018 is the biggest, of course, with a Camp Fire in California. Detrended, on level, that's about $9 or $10 billion industry loss, 60 to 70 year return period. So that's happened recently, right? It's the most severe in the historic record. What is causing it? First of which, we have to detrend for exposure growth in that area. There's been significant exposure growth in the last 10 years, right? Encroaching in the wildland urban interface for WUI. Wildfire is a human peril. 80% or so of ignitions are caused by humans, discarded cigarettes, etc. So it's dominantly, have there been changes in ignition pattern? Then there's other things which are land management practices, there's beetle infestations. If it were possible to detrend, get rid of all of that stuff, you'd be left with drought, which is natural climate variability. That's highly variable on a 5 to 10 year time scale. We need to detrend the natural component if we're looking for an anthropogenic or human climate change signal there, right? So I've given layers of detrending that we need to do. I'm not aware of anyone who's done it yet, right? So, but lots of people have jumped straight away into blaming human-caused climate change as the cause without detrending these other factors, right? So I would agree frequency severity does appear to have increased, but there are many other factors we need to detrend for. Yeah, I'll pause there. Yeah.
Thanks, Nigel. Maybe Shaun and I can just maybe carry on a little bit from what Nigel was commenting on in terms of thinking about what other factors are out there when we start to think about severe frequency or severity changes in what we observe in recent times. I wanted to draw attention to losses that we've seen in Australia in particular. So if we go back the period 2020 to 2022, we had significant losses from a number of different events during those 3 years. We're talking about significant hail events, particularly in 2020, which resulted in close to 4 billion, including a severe East Coast low in losses from an insurer perspective, which is significant to the Australian market. In 2021, we had record rainfall across the East Coast of Australia again, which aggregated toward 2 billion of loss in 2021. And then following that in 2022, we had significant flooding in widespread actually on the East Coast from Tasmania in the far south up to inland and coastal regions in Queensland, with an aggregation of close to 7 billion from an insured loss perspective. So when you have 3 years of intensive frequency and also severity, it certainly starts to look like a period of heightened severity and activity. And I think in terms of, we need to think about how does that impact us? How does that impact the market and what's happening? Obviously, it brings climate change to the forefront, not only from an industry perspective, but also from a community perspective. So climate change is immediately the hot topic, the point of discussion. Everyone alludes to it, and it becomes a catch-all bucket. When we think of impacts, particularly from our industry, we start to see things like secondary perils become a focus of attention, access and structural changes in terms of being able to transfer risk, cost, of course, of that becomes a key factor. And then this general resignation that this becomes the new norm going forward. Well, I think it's important to, as Nigel was saying, there are other factors at play here. Recognizing that obviously there is a climate change signal and we're seeing evidence of that. If you go back to that 3-year period, we also had one of the most severe La Nina periods, which is part of the ENSO or El Nino Southern Oscillation, which impacts Australia severely from a rainfall perspective. And we know that during a strong La Nina period, we have strong evidence of precipitation-induced rainfall leading to flash flooding, but also cyclone induced activity happens a lot more during that period. So it's important to recognize that this was a severe event in terms of underlying climatic oscillations that we have, not just long-term trends from a climate change perspective. So something like La Nina might be on a 3 to 7 year cycle. So you don't expect it to last forever. In fact, we've reverted back towards more of an El Nino episode, which is moving away from a wet period on the East Coast to a more dry period. How that will play out in terms of losses, I guess we'll see over the coming years. But it's important to know where you sit in that cycle. So if you're trying to understand how does the last 3 years in there represent my risk, how does that fit within the models that I use, you need to understand how that fits in the long-term and short-term view of the climate and where you're at in that cycle.
Yeah, thank you. Thank you all actually for you offering insights, comment on the trends. Some of them are not surprising. As Ashish mentioned, some of them at the same time also see some trends, underlying trends. I guess that, firstly, there is a general sentiment from the public because the headline news we see, now we see this 100-year flood. Sometimes 500-year new records. So these definitely give the impression that, wow, this kind of large change or large delta in frequency severity is coming upon us. At the same time, for seasoned cat modelers, you look back, maybe after the 92 Hurricane Andrew, the industry was shocked by that large loss. And then, from there grew out this cat modeling. Many companies from then on relied on cat models. So this leads to our next, actually, I'm taking the liberty combining the two questions together for you. With this change in frequency and severity, as we just discussed about, for the Brad, from the insurance broker perspective, what do you see in terms of the buy side and sell side? What their perception regarding this change in frequency severity? And also for the other experts here, I heard the saying that, frequency becoming a new severity because catastrophe events by definition are low frequency event. In actual modeling, we use frequency, say, Poisson model. If a Poisson model, if we get surprises, we say, no, we just use the negative binomial model. Anyway, from a practical point of view, in pricing, in terms of setting up capital requirements, or even model validation, those would have implications. Now let's throw back to our panelists, maybe start with Brad and then the others will chime in.
Thanks, Shaun. I think there's quite a bit in terms of the question, but maybe if I can just kick off thinking a little bit about the role of an intermediary or a broker in terms of providing advice and context to what we see. I think, you know, I get to see both sides of the story in terms of insurance or financial institutions asking questions about climate change, obviously reinsurance markets asking questions about climate change who may or may not be local to this region in particular. And I think the questions and views tend to shift a little bit depending on what's happened in recent time, and the focus can tend to shift a little bit. Unfortunately, we tend to be a little bit reactive as an industry and not always look at the long-term aspects. But one of the roles we play is to ensure that we educate and put everything into context against the analysis that we might be doing in the background. So if there's an event that's occurred in recent times, it's very quick in terms of what does this mean for us? Is this event being modelled? Did we expect this? Is this the new norm going forward? So part of our role is to have a look at that and say, well, hang on a minute. What we typically pick up is a single point highlight. We might pick up there's a 1 in 100 year rainfall, or there's a 1 in 250 year heat wave. But it might be a singular point and it may not relate to our portfolio as a whole. So we need to say, well, how does that singular metric relate back to the particular hazard that we're trying to understand, whether it be flood risk or bushfire risk, etc. So we have to distill that, look at it, start to analyze it, and say, where does this physical parameter sit in the context of the data that we have? How does that fit in the context of the modeling we do? Does it make sense in terms of the peril severity, the peril frequency? Does it fit the expectation that we have? And then spatially, does it fit the context of what we're modeling, or is this event occurring in a different place that we weren't expecting? So we try to put some better clarity. So when we're communicating these types of risks, we can do it with a more robust context as opposed to just hitting highlight numbers around this is a 1 in 10, 1 in 100, 1 in 1,000 year event, so to speak. And I think it's important to do this because we need to make sure we have a solid grounding of our current day view of risk, using the models that we have access to, and maybe they're not always meeting that, before we then look to elevate or do any climate change related adjustments going forward. We also need to recognize that questions can come in for different reasons. There might be an immediate risk transfer question, which might relate to a time period that's in the next 12 months. We might be looking at underwriting or planning question, which might relate to a short to medium term cycle. Or we might be looking at a regulatory question where an insurance company might be trying to answer, well, how do you envisage climate change impacting you in a 50-year time period? So we have to take all that on board as well in terms of how we communicate the risk and communicate the impact of climate change. And then there's a number of ways we can do this from a modelling framework. But maybe I'll just pause there to give others an opportunity to chime in.
I can go.
Okay, I can butt in if I may. Sorry, Ashish, I think you're about to speak.
Yeah, go ahead.
I think we've grown used to treating CAT as a severity problem. And I would going back to your original point, Shaun, I think I would certainly concur with the view that CAT is becoming a frequency problem. Now, you can frame that in terms of severity, or you can frame it in terms of frequency. Either way, I think we're just seeing more frequency of things which we do not yet model geophysically in the vendor models. And I think to put this in actuarial terms, you've always got an exposure model and you've got an experience model. And, a CAT model is just an exposure model with a lot of parameters in it. I think if we treat CAT purely as severity, then a lot of the recurrence frequency parameterization that we've traditionally used, generally treating this as a Poisson process, is probably acceptable. But as this becomes a frequency issue, I would assert that it is a frequency issue. I think what we're realizing is that the experience models we have are useless. The experience doesn't count anymore, and we need a different view. And a Poisson view is not working. I think if I sorry to harp on about flash flood, but my feet did get very wet, so just bear with me. If we talk about flash flood, you know, as I said, I think we're in the region, we are seeing about 2 a year, causing major losses to each market in which they occur. I think if we then sort of take a wider view of other atmospheric perils, I think the Poisson assumption, as I said, works okay for severity perils, but I think what actuaries need to be aware of is that you can't treat recurrence and severity as independent parameters. I don't think that you can rely upon a Poisson assumption where just empirically we observe that there are many years with no losses. And I think if you parameterize your recurrence as Poisson, and you don't see that weighting at 0 events. There is a tendency to use negative binomial distributions instead. I've never seen a geophysical justification for that. I've just seen people say, there's a bit more tail, so we'll use a distribution with more tail. I do think this is quite a wide question, which is why I bounce backwards and forwards in terms of talking about frequency and severity. But I think the key takeaway is that I just don't think the Poisson model works as we start to experience CAT as a frequency problem. But I'm happy for any of the other panelists to disagree with me.
I have something to say on this question as to whether frequency is becoming the new severity. Also something to say on Poisson versus negative binomial. I'll be as brief as I can. I would argue that yes, and as I pointed out, yes, we have seen a lot increased frequency of what appear to be fairly large losses, beyond attritional type of CAT losses, you know, significant losses. So if I could just hark back to the wildfire example, you know, I already mentioned that the 2018 campfire, when I back tested this against the industry loss distribution very recently, I couldn't get it beyond 70 years, right? So that's the most extreme wildfire we have on the industry basis globally. Right? Nothing in the upper tail beyond a 1 in 100 from my perspective. Right? So when you know, you often do hear people saying today that actually the 1 in 200 is going to become a 1 in 50 or even a 1 in 20. Well, I'd say that to be able to say that is extremely optimistic, right? Because the uncertainty around that 1 in 200 event usually isn't drawn from an event basis, usually isn't drawn from experience. It's drawn from calculation of a very limited data set, right? So if they're saying realistically that a 1 in 200 becomes a 1 in 50 or 1 in 20, take it with a pinch of salt, I would say. And then the final point about Poisson versus negative binomial, I fully get it. You know, obviously Poisson is where the variance equals the mean. There are cases of over and under dispersion, and of course, for time-sensitive periods from the last 5 to 10 years, for example, there could well be a case for using a non-Poisson distribution for many atmospheric perils, something that can handle over and under dispersion. Question is, can a negative binomial handle over dispersion, because the variance is always less than the mean. So I'm not an actuary, I'm not certain about that, but at that point I would pause and hand over.
Yeah, if I may add, yeah, I will not comment on Poisson versus negative binomial distribution. I'm not an expert on that one, but yeah, Shaun, you mentioned about impact of climate change, the delta, whether as a modeler or modeling company, do we consider that one? And climate change is one of the very hot topic. As a modeler, we always get asked that question, okay, whether your model includes impact of climate change or not for particular peril, particular region. Obviously, one thing is that the climate change is not sudden. It has been happening over the last many, many years. We have been seeing the impact of sea level rise, temperature, and in the modeling world, whenever we create a model or we update a model, we try to take into consideration all the latest information I have. And give more weightage to the current years than 40, 50 years ago, how it was. So to that extent, when we develop or update a model, what we say, the model is good for plus minus 5 to 7 years when you're looking at the current climate at this point of year. Certainly, you should not be using our standard model for frequency or severity for 30 or 50 years down the line. For that one, you now have climate condition catalog, or one can create climate condition catalog. So standard catalog, standard model are, when we update a model or new model, they are pretty good for current climate plus minus 5, 7 years. Let's stop there.
Oh, very interesting. Thank you. Our distinguished panelists actually offer very interesting insights, and I may not actually see, my impression, you may not even agree with each other. So it remind me of CNBC talk. One will say stock will go up, the other will say stock will go down. So we're safe. Okay. We have actually, I'm mindful of time. We have another prepared important question. Actually, I will read this question from anonymous audience. Are the current CAT models reflecting well the climate changes? Or this moving part to be taken care by users of model? This actually, this question leads to my actually prepared the next question. Let me just try to articulate the question. The risk carriers and brokers sometimes try to overlay stochastic model output with intelligence or predictions gathered from other sources, from both internally or externally, from experience or exposure extrapolation. So question is, will this approach, let me clarify again, this approach to overlay a stochastic vendor model output with a forward prediction become more important in the future? So that's actually goes back to the audience question, where the user needs to do some kind of overlay modification. So if so, will this trend of overlaying the classic multicolor approach to CAT model with, some user its own intelligence gathering, will this become mainstream in the future? And what are the vendors planning to do? Or will the vendor actually think it's necessary to do so? So that's from vendor perspective. What about the users of the vendor model? I mean, we have users vendor model. So I would even further to add even another dimension, because some of the catastrophe events, there is also human element, is a human factor. So in that case, will some of the mitigation measures also impact your loss experience curve? How that can be, reflected? I mean, it's kind of is basically, put simply, how do you think overlaying stochastic vendor model with some kind of user's own intelligence, do we see this as a mainstream trend? I'm kind of repeating again. Now I'll kick the ball to you, see who wants to go first.
I'm sure we all have many views on this. I would just very briefly say that this is already done quite widely at the moment. We call it a view of risk, right? So we would impose a view of risk, typically often on the lower part of the EP curve from the CAT model, can be on the upper part as well, whole curve adjustment, for example. So that's routinely done already by many market participants. Now that's the longevity of that is typically a few years, or until there's a major change, like a major model release, major model update also. Now I think what you're talking about here really is next couple of years, or even sub-annual seasonal type adjustment. We've got intelligence, but actually, you know, we think it's the Northwest Pacific is going to be hyperactive this year, or North Atlantic is going to be very active. Therefore, so yes, absolutely, we do get these sort of predictions. They come through seasonal basis. To be honest, I personally don't know anyone who actually translates this at present time into that sort of intelligence. And you could argue there's a high uncertainty. What happens when we get it wrong? Who carries the can? Right. So at that point, I'll leave that as an open question.
I mean, I think I'd agree with what Nigel said. The only thing I would add is that I think you need a very opportunistic relationship. As a reinsurer, you need a very opportunistic relationship or an opportunistic market in order to utilize this intelligence. In theory, you're there for the long term to support your clients. So you need to be very careful how you would implement this intelligence in the way you transact with your client base. That said, that's not an excuse for not doing it. I think there's always, an argument for producing a conditional view of the risk which you carry. And yeah, we do welcome the fact that some of the vendors are moving in that direction.
Yeah, if I can add to it, I think the question was pretty loaded and there is various part of that question, and some I tried to answer before. So if you really talk about the models, are the models good for the current climate, plus minus 5-7 years? Yeah, they're pretty good. That's what we try to focus on, whether model reflects the current climate. But when it comes to that, if somebody is looking for predictive analysis, the year ahead or season ahead, then we do get those questions. People have information from various sources and ask us question, okay, how we can incorporate that one. And simply, yeah, someone can answer that the stochastic catalog has thousands of years, and you can identify, okay, which year reflects that higher activity in particular basin, more severe events in a particular year, and you can identify those one. But having said that one, in traditional insurance and reinsurance business, we haven't seen this approach being deployed so much, given that will result into volatility of insurance premium. Let's say insurer charging higher premium 1 year, next year's much lower premium, then again higher premium. We haven't seen that thing. But in certain market, when it comes to investors market in ILS and cat bond, we have seen them when the things get traded and people being little opportunistic on that side, where they try to play around with that. So apart from that area, we haven't seen that seasonal prediction or yearly prediction for pricing purposes. For management of risk purpose, I'm sure some insurers are using it, various companies using it, but not really when it comes to pricing or risk selection purpose. So I'll stop there.
Yeah, maybe I can just comment a little bit. I think AI might have been talked about as part of the process potentially. I agree with everyone's comments around how, we have seen adjustments on a regular basis, and normally they're short-term view. But there are challenges around doing that. I think, AI tends to get used a little bit in forecasting models in particular, and assisting in that process, combining them with physical models or moving completely towards an AI-assisted approach. If we try and embed that into the catastrophe modeling process, we also need to be quite careful. I think you end up having challenges around how do you communicate that, how trustworthy is it? You have internal, external stakeholders who might be making decisions based on that piece. How do you justify and communicate that aspect that you're introducing on top of everything else? Might become a challenge and a difficult thing to do in the short term.
Wow. Thank you so much for, I think I threw at you a loaded question, but I think you answered very well. We have about 5-6 minutes remaining. I would like to really, offer the audience an opportunity to ask a panelist. Actually, also not only the audience, also Andreas also is an expert. So any comments you want to share with the audience, you're welcome, Andreas.
Thank you, Shaun. I'm not the expert in this room. I'm the one I'm the one getting the experts to share the views with our audience. Yeah, it was a fascinating panel. We have been provided the broker's perspective, the model vendor's perspective, the insurer's perspective, the reinsurer's perspective, and all engineered nicely by someone coming from the academia's perspective. So truly enjoyed this panel. I also liked how the moderator spontaneously combined two questions, one question from the audience with one of his own, thus added a third one on top, but the panelists elegantly avoided all three questions, I'm tempted to say. Oh, they didn't. They answered the questions very well.
Yes, thank you, Andreas. Actually, we got another question from the audience. So I will actually give this opportunity to the audience. Is climate risk insurable under this climate changing environment? Actually, I would just also ask the panelists, because for this future proofing of the catastrophe models for Asia, you know, you talk about the new perils need to be modeled. I mean, Asia, in terms of regional difference, is not that in terms of has not used models, especially vendor models, as extensively as, you know, US or Europe or Australia. Anyway, what other insights you would like to share? Maybe 1 minute per panelist. I mean, you can answer those questions, or you can just take the opportunity to offer additional insights. I mean, 1 minute per panelist. Yeah.
Oh, okay, I'll jump in. Go ahead. in front of Nigel. I guess we've been told we didn't answer the question on whether current cat models reflect climate change. I think it depends what you're asking it to do. If you're treating your catastrophe, atmospheric peril catastrophe model purely in terms of severity, looking at your 1 in 200 loss, then there are solutions which the vendors are offering. I think in terms of emerging perils, which are becoming a problem, or atmospheric effects, which are suddenly causing large insurance losses and are surprises, these are not covered by the vendor models. And it's beyond the scope of what the vendors have been asked to do so far. So it's a little bit unfair to criticize them. Is climate risk insurable? Well, it's a really good question. I think that's a bit beyond my remit to be able to answer that. What I would offer is that it's worth remembering what our industry exists to do. It's there to compensate accidents. It's not there to subsidize the inevitable. So if we think that these risks are inevitable, then it requires an adult dialogue between carriers, regulators, and governments as to what we do about it. It's not just for the insurance industry or the reinsurance industry to pick up the bill.
If I could just jump in with my 30 seconds to a minute, the thing that I'm looking to for the future that's going to future-proof for cat modeling for use in Asia and worldwide is the introduction of quantum computing if and when it ever becomes operationally successful. I can see dramatic uses ranging from huge stochastic catalogs, much more than 300,000 years, operational use of uncertainty, representing when you're doing a pricing, for example, for consequent event trees beneath each stochastic event, like having a mini stochastic event set beneath each stochastic of consequent outcomes, secondary perils, And then, of course, there's high resolution regional climate modeling, 1 kilometer or sub-kilometer scales. Not possible. It's only possible for very small areas using an ultra high resolution weather model today. I'd like to see this running at that resolution years into the future. It's not possible at the moment. It's computationally far too demanding. It potentially could be possible if and when quantum computing comes to the fore.
Yeah, thank you, Nigel, for quantum computing. Okay, Brad and Ashish, very quick, maybe 30 seconds, then we can conclude.
Maybe just to lead on for Nigel a little bit, I think, CAT modeling generally, the platforms we use are a static environment, which is fine. It has its advantages. I think probably going forward, we'll start to see these things become a little bit more dynamic. So you can feed into them updated information on a more regular basis as and when it's needed, and provide more flexibility from an end user perspective to have control over those aspects. It'll also help, CAT models have a good platform in terms of calculating financial risk related to CATs. I think we have the ability to deploy this more widely in terms of how we plan in society to deal with CAT risk going forward, which is a key issue.
Ashish?
Yeah, if I just talk about vendor's perspective, whereas for Asia Pac, if you just compare the number of models which were available for Asia Pac 10-15 years ago versus now, it's a dramatic change. The number of perils, number of countries that has been modeled. But having said that, we still have a long way to go. As Iain said, there are a lot more emerging perils where clients have asked him to develop the models. Resolution of the model, certainly. Nowadays, I would say still, we are pretty good when it comes to resolution of model. Asia Pac have come far long. Even if you compare the resolution or quality of model are very similar to US, Europe, there is not much difference. But there are still, we are talking about vast region, number of countries, number of perils, and that certainly would be the future for Asia Pac modeling.
All right. Well, it's time to conclude. I would like to thank our distinguished panelists, Ashish, Iain, Brad, and Nigel, for sharing their insights. Now I want to return back to Andreas.
Thank you, Shaun. Thank you, distinguished panelists. For the benefit of the mainly actuarial audience, as you may have seen, CAT modeling and catastrophe management is not just running the model. CAT modeling is a process, and future-proofing the CAT models also means future-proofing that process. And to some extent, the way this process is currently happening is already ensuring that, for instance, the output is getting interpreted. So the process as it is now is already ensuring to some extent that the output from the CAD model is not just used without interpretation. So similar to the pricing actuaries in this room, pricing is not just running a pricing tool, pricing is a process. So one of your take-homes should be CAD modeling or catastrophe management. Similarly, it's not just running a model or two, it's an entire process.